Guys, I hate to break it to you, but if you're investing in dividends right now, you're probably wasting your time and you're wasting your money, and most importantly of all, you're wasting your potential for massive future growth. Dividend stocks right now have been getting a lot of hype because, I mean, who doesn't want some passive income? Passive income is a very hot and popular topic right now, and it's getting a lot of, interest in it. I mean, who doesn't want to own these companies that pay out dividends every single month, every single quarter, maybe every half a year, maybe every full year? I mean, who doesn't want to own companies that spit out dividends like that? I totally get the allure of it, but unfortunately, you are wasting your time. Unless you're in a situation where you're, getting retired or you're close to retirement and you just need the passive income and you just don't want to worry about it. You've already built up a nest egg and you just want money flowing in every so often. Dividend investing is probably not for you. We're going to jump into my computer here and take a look at an example here together so I can actually show you what type of gains you're actually missing out on by going this dividend route. I hope that I can give you some insight as to why this is probably not the best avenue for you and give you a couple of examples of better investments that you could have made, still staying in the stock market, but having a better outlook of being able to get massive potential gains. So with that being said, let's jump right in my computer here. Okay guys, so I want to give you an example here because I think this is going to be the best way to really explain what I'm talking about here. Obviously, if you've got some money in the stock market, you know that, hey, the stocks go up and they go down. The example that I want to use for this is if you had $10,000, how would you invest it? Well, first, let's take a look at AT&T. This is a very popular stock that has been getting a lot of interest lately because it puts out a very good dividend. For this company, it has a very healthy dividend of 7.4%, and these dividends can range, lower than that, 0.1% range, and they can fluctuate all the way up to 10% or more. AT&T is a pretty good, safe, stable company that sees a lot of interest because of the dividend that it spits out every single quarter. So AT&T is currently priced at $28.76. You can see that right over here. And we're going to take a 5-year example, and we're going to say you invested $10,000 into this stock. I want to show you the graph here and show you the ups and downs that this particular company has had over that time frame. If we actually zoom out here a little bit, you can see that going back 5 years puts us at the end of 2015. Which if we look at it here, let's see where we're at here. That gives you a stock price of roughly, somewhere in that $28 mark at the end of 2015. We saw a big increase, a little pullback increase, and then kind of just traded flat, honestly, came back down in 2018, shot up to almost $40 in 2019 before crashing back down again to this $28 mark. So over that time frame, it has literally moved like basically nothing, right? Well, that's because they spit out massive dividends every single quarter. The 7.44% for the dividend is pretty healthy. That's a really good dividend amount, so I can see why there's a lure there to actually invest in a stock like that. However, I've got some numbers here, and we're going to follow along here on the screen to actually show you what I'm talking about and why this is important for you. I've got $10,000, and we're going to invest that $10,000 in AT&T. I used a share price of roughly $27.50, which it was roughly around that end of 2015, which is going to get you roughly 363 shares of that company. Current dividend is 52 cents per share. I'm going to take this dividend and just assume that that's what it's been for the last 5 years, every single quarter. That being said, with these 363 shares, you would be getting paid out $188.76 per quarter, which is $755 per year, or a total of $3,775 for the total of 5 years. Not bad, right? Pretty good investment. I mean, it's not bad. 7.4%, that's almost guaranteed. Really not too bad. But the downside is you are going to have to pay tax on that, and so it doesn't turn into that good of an investment. Yes, it is a little bit safer of an option, but there's way better alternatives out there. Let's take a look at one of my favorites. So if we actually scroll down here, we're going to take a look at the company Square. Square is that company that makes those little chip readers that you see at like farmers markets or your barbershop or basically any small business out there. They also do things such as business loans, and they have their Cash App, which is rapidly growing in popularity. Looking at this company, you can see that they IPO'd roughly the end of 2015. If we jump back over here to Webull, where you can get your 4 free stocks using the link in the description below, let's take a look at Square. Square has been on an absolutely massive tear lately. You can see this amazing stock chart here. It looks absolutely beautiful. At the end of 2015 is actually when this company IPO'd. They had a share price of roughly $12 at the end of 2015. So if we took that same $10,000, invested it into a company like Square, which was just a small company at that time, nowhere near the behemoth that it is today, But if you kind of said, hey, this looks like a company that could be going somewhere in the future, and you took that $10,000, you would get 833 shares of that company. At today's price, those 833 shares would be worth over $181,000. Absolutely insane, guys. This share price right now is at over $217 per share. It was at $235 just a couple of short days ago. So that's one example. Well, okay, let's say maybe you didn't pick up on the Square trend. You didn't notice that they were going to be the best company out there, right? They weren't going to see those massive gains. Maybe you went with a little bit safer play and you went to a company like Facebook. Facebook was a very well-known company at that time, had a lot of market share and was growing very rapidly. Obviously had a lot of user engagement, a lot of people using it. And so a little bit safer of a play, right? Maybe not so much in the financial startup space, but a little bit safer play, a company that was beginning to produce large amounts of revenue at that time. Let's say you invested in Facebook as well. It was still pretty big. At the end of 2015, it had a share price of just under $105, which would give you roughly 95.5 shares of Facebook, which at today's price of $273.16, that is worth over $26,000. That's way better than the $13,000 worth of capital you would own with AT&T, right? You've got the $10,000 of stock that you own because the price of that stock didn't really fluctuate, and you did get $3,500 roughly in dividends, or $3,700, excuse me, of dividends, but you did have to pay tax on that, right? These stocks, assuming you haven't assuming you haven't cashed out of them and realized that profit, you might not owe any tax on this just yet. So you've got over $26,000 here, even with a safer company and a safer bet like Facebook. Let's take another example. Maybe you went with Amazon. Amazon's been absolutely blowing up. Again, in 2015, it was very well known. It was becoming a large company. It was taking over the world. And at the end of 2015, you would have had a share price of $666. Maybe a sign? I don't know. Don't count on it. That's just what the share price was. This would have gotten you roughly 15 shares using that $10,000 at today's price of $3,256 per share, over $48,000 worth of capital there if you invested $10,000 into Amazon just 5 short years ago. That's an absolutely phenomenal return. Turning $10,000 into $50,000. Not that bad, right? Much better than a 7.4% dividend return. Now, again, just to beat the point in a little bit further, let's take a look at a stock such as Tesla. What would happen if you put $10,000 into Tesla just 5 short years ago? Man, I wish I would have done this because I would be sitting very pretty. This is a company that I invested in over the last, year and a half or so as I got more familiar with it. And man, I wish I had gotten in at 2015 because I would be sitting very pretty if I had. Yes, very pretty. So $10,000 would have gotten you roughly 210 shares. At the end of 2015, the price was at $47.63. This is, with some splits in there. I know that's a big factor with Tesla, but this was right before a major sell-off of the stock. That would have gotten you 210 shares. 210 shares of Tesla would be worth just over $148,000 at today's pricing. Yes, Tesla was a very volatile and very risky stock at that time. Nobody knew if the company was going to make it. One of the riskiest stocks in the market at the time. But let's just even look a little bit deeper. If you'd bought that dip right after the price dropped going into 2016, and it was the share price was down to $32. Those shares today that you would have gotten with that $10,000 would be worth over $220,000 total. So guys, I think I've made my point here. Yes, of course, AT&T is a little bit safer of a play, but I would still argue that there are better places to put your money. If you're going to risk losing $10,000, wouldn't you rather risk it with the chance to earn $150,000 to $200,000 over the next 5 years? Or would you rather make the safe play and only make $3,500? I don't know about you. I don't want to lose money, but hey, I would definitely invest with the higher upside into some of these companies. Maybe even take $2,000 and invest it into each of these 5 companies. You'd still be sitting very pretty. Honestly, I don't know. With some quick math, just off the top of my head, I think you'd probably be sitting somewhere between $70,000 and $80,000 worth of value if you just split your money up between these other stocks and put, $2,000 or $3,000 into each of them. So definitely still a lot better than the AT&T dividend that you're going to get. So I would just ask you guys, what companies are going to be the behemoths in 5 years? I want you to think about this. What companies right now are going to be very large in 5 years and have a very good chance of having their stock price 10x, 50x, 100x I don't know. I don't have the answer for you, but look around you, see what's going on in the market, see what better options are out there other than going with a dividend play, because I guarantee you there are some options out there that are going to be better. And like I said, unless you're in retirement or very close to retirement and you just need a place to park some money and get a little bit of passive income each month, you're going to be way better off investing in these companies that have very high growth potential. Especially if you're young like me, you're in your 20s, you're in your 30s, even if you're in your 40s, you're going to be way better off investing in these companies that have the chance to absolutely explode. So with all that being said, guys, I hope you enjoyed this content. If you did, give me a thumbs up here on the video, share it with a friend, a family member, a spouse who needs to learn this lesson as well. It would greatly help me out with the YouTube algorithm, and I'd really appreciate that. Don't forget to subscribe to the channel, and don't forget to check me out with the Patreon link down in the description below. I'm starting to release content over there that is going to be exclusive content that you're going to want to know about if you like enjoying my story and you want to know more about what I'm doing with my stock portfolio. Definitely check that out. With all that being said, guys, I will catch you in the next one.